Okay, here's the part we didn't get to when we were reviewing. Treasury stock is the last concept that we did not cover when it came to corporations. We'll finish that and then we'll move on into partnerships, which is chapter 12. Okay, we're going to buy some treasury stock and then we're going to sell the treasury stock. So the first thing here, we have 1,000 shares of treasury stock are purchased at $40 a share. Let's just make up some dates. Let's say we're doing it on January 1st. We are going to debit treasury stock. Okay, and the amount we use is simply going to be what we paid for it. It's the cost method. It costs us $40 a share. We're going to multiply that times 1,000 shares. And that treasury stock cost us $40,000. And of course, we used up some cash to buy it. So we're going to credit cash $4,000. So that's the purchase. Now we're going to sell some treasury stock. Okay, let's say we turn around and we sell it on the 20th. We're going to get cash. Okay, and it says we sold it for $45. So our cash is going to be 45 times the number we sold, which is 800 shares. $36,000 in cash. Now the treasury stock has to be credited, and it is going to be credited based on what it cost us. So these 800 shares we just sold, they cost us $45 a share. Okay, so 800 times 45. I'm so sorry. Never mind. Okay, they cost us $40. Yes, there you go. $40 a share. Okay, so we're going to credit $32,000 to treasury stock. The difference is going to go to paid in capital from the sale of treasury stock. Okay, let me make this bigger. Okay, and we can see the difference is $4,000. Now we could also prove that $4,000 if we wanted to. We had bought it at 40. We sold it at 45, so that's $5 extra per share. 5 times 800 would give you that same $4,000. Now let's go ahead and finish selling it. At the end of the month, we sell the rest of it. Okay, so we're going to get some cash, and we are going to get $38 a share on this one. So 38 times the 200 shares. Cash is going to be $7,600. Okay, then we're going to credit treasury stock. And again, it has to be credited based on what it cost us. So those 200 shares cost us, remember up here, $40 a share. We're going to credit treasury stock for $8,000. Now, I should have skipped a line. Let me see if I can just copy this and put it down here. Okay. Because we're going to need an additional debit now to make this balance out. Because in this case, we got less cash than we paid for it. So now we're going to debit that paid in capital from the sale of treasury stock. And that's going to be the $400. And we can prove that $400 because we sold each share for $2 less than it cost us. $2 times 200 gives us that $400. So before we leave the treasury stock area, I'll ask you a couple more questions. One, what is the gain or loss from buying and selling this treasury stock? We bought it at 40. In the first transaction, we sold it at 45. So what is the gain? 0. You do not recognize gain or loss from selling your own stock. That's why we have this paid in capital from the sale of treasury stock line. It goes straight to the stockholders' equity section. You don't recognize gain or loss. So I can ask you the same thing down here. We sold it for 38, but we paid 40. So what's your gain or loss? It is still 0. You do not recognize gain or loss from the sale of treasury stock. Okay, now the only other thing to remember on treasury stock, if you remember the handout that we did today, we did that statement of stockholders' equity. Where does the treasury stock get reported? Remember that it is a deduction from stockholders' equity. Get that sheet out and look at it, and you can see where the treasury stock is placed in the stockholders' equity section. Okay, so let's move on now to partnerships. First thing we're going to do with partnerships is we're going to have like an initial investment and contribute some assets to the partnership. We are told that this person is going, this is only one of the partners, we're only going to focus on one. This person is contributing this right here to the partnership. Cash, accounts receivable, equipment. The equipment has accumulated depreciation of $10,000. Accounts payable. We're also told the current market value of that equipment is $35,000. Notice we're carrying it at $50,000 with a $10,000 accumulated amount, so we're carrying it at a net value of $40,000. It's only worth $35,000. Okay, so what are we going to do? I'm going to give it a date. Let's say it's March 1st. The cash we're going to put in at that value. Okay, so that is $10,000. We're going to recognize the accounts receivable. Now, we're going to go ahead and say the accounts receivable is worth what it says it is. It's entirely possible that you could get a problem where it tells you the accounts receivable is worth a different amount. If it says it's worth a different amount, use the different amount. If there's an allowance account, use the allowance account that is agreed upon. Okay, remember, anything contributed is agreed upon amounts. So that's the receivables. The equipment, we're going to use the agreed upon amount, which is typically fair market value. And down here it says current market value is $35,000. So that's what we're going to use. Okay, now we're bringing some of our liabilities with us. And our liabilities are $3,000. The remaining portion is going to go to the partner's capital account. Okay, and so we're just going to have to find the difference. This is going to equal the sum of all these numbers, okay, minus the liabilities. They would have a capital amount, an investment total of $57,000 for what we're doing right here. Okay, now I went ahead and made another note down here. This was for an original investment into a partnership. It does not matter if it's the original investment or if you're adding a new partner after it's already existing. You would still have to mark all of your assets back up to fair market value before you added this new partner also. Okay, so you know, if you have a new partner coming in, find out what the new value of the equipment is. Go ahead and mark up that equipment. If it's land, mark up the value of the land. If it goes down, mark it down. And go ahead and recognize any gains or losses involved with those. They'd be unrealized gains. Remember, unrealized means it hasn't been sold yet. But whatever that gain is, you're going to go ahead and divide it among the existing partner's capital accounts before you admit that new partner. Because failure to recognize that gain or loss before the new partner is admitted would possibly mean that in the future that new partner would end up recognizing some of that gain or loss that really was not his or hers. Okay, anyway, so just remember, when you have that original investment, everything goes to market value. If you add another partner in before the addition, you also have to step up the basis in all those accounts to fair market value. Okay, let's move on over here. Okay, we're going to calculate some ending capital here. I've got David and Matt. They have capital account balances of $42,000 and $52,000 respectively. So I'm going to put those in here for their beginning amounts. That means altogether our beginning capital is $92,000. Okay, now we are told that net income is $81,000. Well, now I'm going to stop here and we're going to do an allocation of income in the middle of this one. Okay, so we know that our income, as I said, is $81,000. I'm just going to go ahead and drop that down over here. It says that David has a salary allowance of $24,000, so we're going to put $24,000 right here. Matt has a salary allowance of $30,000. Altogether, we have then allocated $54,000. Okay, so what remains to be allocated? 81 minus 54 is what? Okay, we're going to take 81,000. We are going to subtract the 54,000. We have to still allocate $27,000. Now, it tells us that the remaining income is split 2 to 1. So this ratio is 2 to 1. Remember that 2 to 1 ratio means that even though there are 2 partners, there are 3 parts. The first partner gets 2 out of 3 parts. The second partner gets 1 out of 3 parts. So 2 out of 3 parts is going to go here, so we can just say this is equal to 2 out of 3 times this $27,000. Okay, so this person's getting 2/3, 18,000 of it, and that leaves the remaining 9,000 for Matt. Okay, now that we've allocated everything, we can add them up. Okay, David's going to get 42,000 and Matt's going to get 39,000. Altogether, that adds up to our 81,000. So back to this problem over here. We got beginning capital. To that capital, we're going to add net income. David is getting 42,000. Coincidentally, it is the same as beginning capital. That was not intended. 39,000 is going to Matt, and that means we've given a total of 81,000 in net income. Now we're going to subtract our withdrawals. Okay, up here it says David withdrew 10,000, and Matt is going to withdraw 5,000. I'm going to go ahead and put negative numbers in front of these. Make sure everybody remembers they are subtractions. Altogether, the withdrawals were 15,000. Okay, so now we're just going to run these. Hold on here. Order. Okay, the ending balances. 42,000 plus 42,000 minus 10,000 is 74,000. 50,000 plus 39,000 minus, oops, let's go ahead and put the 500 in there, my bad. Okay, 50,000 plus 39,000 minus 5,000 is going to give Matt an ending balance of 84,000. And if we did everything right, we should say 92,000 plus 81,000 minus 15 is 158,000. Let's go ahead and just double check our math, make sure they add across. 74,000 plus 84,000 does indeed equal 158. So the math worked out on that. Okay, so calculating the ending capital, you got beginning capital, you add net income, you subtract the withdrawals, and you get the ending capital. If there had been some kind of additional investment in there, you would also have to add the additional investment in. Okay, so the capital itself is one problem. The allocation of the income itself is a separate type of problem, but they worked well together right here. Remember the allocation of income, allocate whatever they tell you, and then come up with a remaining portion to allocate, and then you can divide it up. Now in this case we said it was a 2-to-1 ratio. If you had not been told what the ratio was, you would assume it's 50-50 since there's two different partners. It doesn't matter what other things they throw out there. They could give you different capital account balances and just state them. But if they don't tell you how it's going to be split, it is still 50-50 or equal. Depending on how many it is, it's going to be equal. Okay. Moving down here to the end, let's take care of a liquidation. Okay. We set up that this company has 56,000 in cash, 96,000 in non-cash assets. Then they had 32,000 in liabilities. We still have David and Matt here. We've added on an additional partner, Rose. Do not try to match these numbers up with anything we did up here. We're just starting over, okay? Just happen to keep the same names for David and Matt, and we added their companion, Rose, over here. Okay, so we're going to sell our non-cash assets. These assets are being carried at 96, so we know we got to subtract 96,000 here to make them go away. Now, I did not write down the amount they were sold for. Let me do that right now. Let's just go ahead and say these non-cash assets are sold for 90,000. Okay, so sold for 90,000. We were carrying them at 96. We can add cash of 90,000 here. We subtract the 96,000 there. So that is a $6,000 loss on realization. Okay. We've got to take that $6,000 and we have to allocate it between these partners right here. Okay, I just added the fact that they have a 3-to-2-to-1 ratio. So we're going to take that $6,000 and we're going to divide it up 3-to-2-to-1. Okay, so the 3-to-2-to-1, I actually already had this on the screen. That means this person is getting 3 out of 6 parts. Remember this 3-to-2-to-1, 3 plus 2 is 5, and 5 plus 1 is 6. There are 6 parts, even though there are 3 partners. The first one is going to get 3 out of the 6 parts, so I have done that right here. I put a negative sign simply because it was a loss, but this person gets 3 out of 6 times the $6,000. they're going to absorb $3,000 of this loss. 3 out of 6 we know is also the same as 50%. You need to be able to take a ratio and figure out what percent it is also. So this 3 to 2 to 1 ratio, the first partner is getting 50%. We move on to Matt here. Okay, Matt, he is going to get, and again I'm putting a negative sign just because it's a loss, he's going to get 2 out of 6 of these parts. Okay, 2 out of 6, same as 1/3. 1/3 is the same as 33 1/3%. So he's getting 33 1/3% of this loss. That times the 6,000. Matt gets $2,000 right there. Okay, Rose, on the other hand, Rose is going to get 1 out of 6 parts of the loss. So we're going to put equals, again a negative, 1 out of 6 times $6,000. Rose is going to get 1,000 of the loss. So altogether, 3 plus 2 is 5, 5 plus 1 is 6. We have allocated the $6,000 loss appropriately. Okay, and 3 to 2 to 1 ratio again. First person gets 50%. The next person is getting 66.6%, and then the last person is getting 33 1/3%. Just a side note on other ratios, if we were saying that something was simply a 1 to 1 ratio, you would say that each partner is getting 50%. These are equal parts. Okay, let's move on with our problem. Okay, after this realization, let's see what happens. We're going to add up our cash at this point. Okay, so we have cash of 146. This is now 0. Liabilities have not changed. David's capital has went down by 3,000, so it is now 52,000. Matt's capital has went down to 43,000. And Rose's capital has went down to 19,000. Okay, and let's just do a quick math check and make sure we haven't messed anything up. Okay, so this side of the equation is still 146. It is in balance. Cash is 146. Okay, so now let's pay our liabilities. We're going to take cash away. Okay, our liabilities are 32,000, so we're going to subtract cash of 32,000, pay off these liabilities. Okay, and then we're just going to get new balances again. Okay, let me put some things here so you know where balances are coming in. Give me just a second. There. And there. Okay, so we had 146 in cash. We just paid off 32,000 in liabilities, so we're going to subtract this 32,000 and get 114,000 left in cash. This is now 0. The capital is still 52,000 for this person, 43 for this one, and 19 for this one. Okay, so the question now is, how do we take this cash and allocate it to these different partners? Don't attempt to bring a ratio into this. That makes it much more harder, and it also makes it wrong. The point here is we're trying to close out the account. Take the cash, which equals exactly what these capital accounts are, and give it to them in the amount of their capital accounts. So this person is going to get 52,000. Okay, we're going to take it out of their capital. This person is going to have 43,000 that's given to them, and this person is going to have 19,000 given to them. And you can see, if we use the sum button here to add these up, we have spent the 114,000. It evens everything out. At this point, you know, everything is 0. Okay, we have properly closed out all of these accounts. So remember, once you get to your ending balances, all you have is cash and remaining capital. They just simply get the cash that matches the amount of their ending capital. Okay, I believe that is everything that I intended to cover. Hopefully that'll help. Remember, bring a Scantron, bring a calculator, and if you have any questions, please feel free to send me an email. Thanks.